Well, good day to all of the viewers that have joined to watch this live and pre-event analysis of the US CPI inflation print out at 1:30. I just prepped some slides together. I wanted to put some of the main factors that I think the key factors that you'd have on your radar. Um, and without further ado, let's begin. We've got about 10 minutes until the main event kicks off. So what this chart shows here, we've got the dot plot. It's where the Fed expects rates to end at the end of 2022, end of 2023, end of 2024, and then longer term. And then I've overlaid that, that's the green line, and then I've overlaid that with a purple line, which is the market's expectations of rates. So we can obviously see quite a clear divergence here, and that begs the question, is there an opportunity for the dollar to strengthen further as the divergence between the two camps close? So we're looking at around, the market clearly expects the terminal rate to be lower and reach quicker than the Fed does. Currently, there's a 50 basis point gap at the end of 2023 and a 100 basis point gap at the end of 2024. The market's clearly expecting a faster and swifter rate cutting process as 2023 gets underway too. And as I say, this begs the question if we can see that gap narrowed and it be positive for the dollar. Moving on to the next slide, we've got a history here of inflation beats misses and the reaction of the dollar. Historically, inflation has typically beaten estimates, so the form book suggests a high probability that we get a number north of expectations. We can see from March of this year that the reaction of the dollar to the beats upside surprise has been positive. Given the Fed's data dependence approach, a beat should be dollar positive and a miss dollar negative. The market's clamoring on to this dovish pivot and peak inflation narrative, and that would fuel the fire in that front. The next chart, what I have here is the break-even inflation rates across different time periods, so 2, 5, and 10 years, and it's what the market expects inflation to average over a 10-year, 5-year, 2-year period per annum. So we've seen there has been a slight uptick from June. However, there's been a massive decline since March across all the different time periods, and I think this is what the Fed will want to see. And it shows that their credibility of fighting inflation, in their opinion, is still intact, and they're doing a decent job for the time being. The 5-year is probably the most important, the medium-term figure. It's still around 70 basis points higher than the target of 2%, but it has come down significantly from above 3.6% back in March. The next slide here, what I have here is the pricing per meeting. And we can see that the market's priced for 69 basis points in September, and across there moving on, which is a 76% chance of a 75 basis point hike. So pretty high chance. Could a hot CPI print put 100 basis points on the table? I think that's a big question the market's trying to ask. And then we got close to 50 basis points for November and 25 basis points for December, 38 November and 18 priced by the market. So not there exactly, but not far off. If it followed that path, it would bring the end of year rate for this year to 3.75 to 4%, the upper and the lower bound for the Fed funds target range. And the market, currently is priced for 3.68% for the terminal rate. What the terminal rate is just what the market expects the peak of rates to be, the highest that it'll get up to, and then either stay there or roll over lower. And the other thing is, obviously, the big question the market wants to know is the terminal rate going to move above 4%? I think that's another bullish feature for the dollar that could catalyze it and move it higher. Moving on, here we've got the 2s10 yield curve inversion, which you can create yourself on TradingView, and we can see it's getting very close to these negative 50 basis points inversion back in the dot-com bubble around this area in 2000. Back in the 70s when Volcker was around, long before I was born, the 2s10 curve actually inverted over 100 basis points. So I think first hurdle to clear would be 50, and then if we get back to the 70s in Volcker era, we could be looking at 100 basis points. Recession is always eventually followed, but the shortest gap between that and recession is around 9 months over the last 70 years. 2-year yields would spike if we got a hot CPI print, and the inversion would get steeper. That's basically how it works. You take the 2-year yield You take the 10-year yield and you deduct the 2-year yield. So if the 10-year sort of doesn't really do anything, the 2-year yield spikes, that's how it becomes more negative. Next chart I've got up here is the euro dollars futures curve, and it's looking at the difference between the December 2022 and the March 23 rate. So the market was pricing in around a full 25 basis point rate cut, around 2 weeks ago. It's now pricing in just over 5 basis points. So a lot of that's been unwound. And if we look actually from December 2022 to December 23, they've got around 66 basis points of rate cuts priced. I think a hot CPI number could quash the idea of a dovish pivot by the Fed and keep rates elevated for longer. Remember, when we're in a different structural inflation regime at the moment. So I think, one has to be mindful of that. I think the market's calling a dovish pivot far too quickly, especially after that very strong labor report we saw on Friday. The next chart, interesting one from Bank of America. It shows how entrenched and elevated inflation is and the slowdown needed in those month-on-month figures to get back to the 2% inflation target of the Federal Reserve. And we can see if every month-on-month print going forward is 0%, and at the end of 2022, we'd still be sitting at 6.3% year-on-year, which is 4.3 percentage points above the 2% inflation target. So a big, big challenge for the Fed. I wouldn't like to be in their position right now. Right, let's get on to what the market's expecting. So 8.7% year on year and 0.2% month on month at a headline level, while 6.1% year on year and 0.5% month on month for core. I think a number between 0.1%, 0.3% month on month should lead to a fairly muted market reaction, and a number below 0% negative month-on-month print or below 8.4% year-on-year. The pricing for September meeting would probably come close to 50 basis points. Gold risk assets like the NASI 100 and crypto would spike, while the dollar would slump. 2-year yields would decline, and the 2s10 curve, which I showed earlier, would re-steepen. A number north of 0.5% and north of 9% year on year, a 75 basis point hike in September would be a done deal, and 100 basis points could be put on the table, maybe an intermeeting hike at Jackson Hole. 2-year yields could spike high and push the 2s10 curve deep into inversion. The dollar would rally hard, particularly against the JPY, and tech and growth stocks could be put on offer, the NASDAQ 100. Gold should drop lower as real yields spike too. The key factors to have on the radar, continuing, just finishing off. The other interesting question I've been pondering is what happens if the headline rate declines, lower gasoline prices, but core increases. Personally, I think the market is more sensitive to the headline number, but this meeting will give us the opportunity to get a read on what they actually value here. The narrative of peak inflation, have we seen the worst of it? That will also be answered today. The Fed knows their credibility is being questioned, and this might make them stay hawkish for longer if they think it could help their tattered reputation. It'll be interesting to hear from Fed speakers Kashkari and Evans post the CPI number to understand how they believe it'll impact policy going forward. And then lastly, as we're getting really close now to that 1:30 time, the FOMC, some key dates going forward. The FOMC July meeting minutes are out on the 17th of August. We've got the Jackson Hole Symposium on the 25th to the 27th of August. And then on the 2nd of September, we've got the August non-farm payrolls. And we've got Powell's speech on the 8th of September. And another CPI inflation number out from the US on the 13th of September and the 21st of September, the big FOMC meeting. Well, we're almost ready now for this key release. I'll just pop up my charts, get it ready before we get started. And I've just created basically a kind of a watch list here of all the key assets that I'm going to be watching as that number drops. We're 1 minute out. I've got gold, the US 500, S&P 500, pound, dollar yen, dollar index, and the euro US dollar. I also look at the yields and what that does as the number actually gets released and what the yield curve does. Let us now get ready for that CPI number. We're 1 minute away. Oh, right. We're seeing a big reaction here at the moment. We can see something's going on here. Um, the dollar is dropping like a stone. I think somebody's leaked the report potentially because nothing's come up yet, but clearly it's a miss. The cable surging. Here we go. It's coming through now, breaking. Um, 8.5% year-on-year headline level. So we did miss what was core. Core also missed forecast, so a miss all around. Heavy dollar selling on that number. Core came in at 5.9%. So the dollar's getting trounced. As I said, the Fed are more data dependent now, and because that data is softer, they're not going to have to be as hawkish. Let's see what the rates market's pricing in. The dollar yen is absolutely dropping like a stone. It's fallen three big figures and counting. I've never seen volatility like this. Wow, it's exceptional. Um, US 500's rallying, gold's rallying through 1.8. It's just crazy what's going on right now. Euro, US dollar. Let's have a look at what those 2-year yields are doing. Let's have a look here. So the 2's 10 curve is inverted, is moving slightly back higher. We zoom out on the daily time frame here. We can see we right up into that 42K level, almost resistance on the S&P 500. The dollar's gone straight through that 50-day simple moving average. Gold, again, putting some distance between it and its 50-day simple moving average through that 1,800 resistance. Let's have a look at the euro. Pushing through that 1025 resistance, 1028 resistance. Cable, again, jumping higher through its 50-day simple moving average, seeing a really big move there. What's crypto doing? Bitcoin's up quite a bit. Trying to look at that 25K level. Let's get dollar yen. Dollar yen, big sell-off. And now we're seeing a rate cut not being priced. We can see here it's moved slightly higher. And let's take a look at the two-year yield. It's down by about 13.8 basis points. Let me put it on candle form, and we can get a nice look there and see the bar. So we can see here, we can see it's down quite a lot there, 14.7 basis points now. Let's have a look at what the market's pricing in here on rates, rate expectations. I want to see what that September meeting's gone to now. Fed fund futures. So we can see that rate bets are being priced out. I want to get us that exact number. But yeah, this is a massive downside surprise, and risk is clearly liking it. Let me just try and find that, what the market is pricing in here. I would say now that it's getting closer, 69 basis point would probably be falling closer to 60 basis points and moving close towards a 50 basis point hike for September. 100 basis point hike now being taken off the table, and certainly an intermeeting hike doesn't look likely now. So that's where we are at here. Let's go back to our chart and see if there's been any other moves compared to the initial reaction. Yeah, so as I was saying earlier, it's just come through now. Bloomberg, the Fed seen raising interest rate by 50 basis points in September compared to closer to 75 prior to the CPI report. So yeah, the market has clearly priced that out. And yeah, we're seeing asset classes dropping like a rock across the place. I think it certainly takes the pressure now off the Fed. And that's it for today's analysis. I hope you've enjoyed this live analysis of today's event and the outlook going forward. And join us next time for another major event. Thank you for tuning in.